Hi everyone, in this video I'm going to answer which one is the better stock to buy, Roku or Fubo TV. Of course, I'm going to judge these two based on important metrics. I'm going to look at 5 of them starting with revenue growth, so let's get right into it. Looking on the top here, Roku's revenue growth soared to above 75% in a quarter during the pandemic when we were all staying home, watching a lot more content on our TVs. Roku and Fubo TV, for that matter, both benefited from that trend. And however, that's coming downward. As you can see, Roku's growth has fallen all the way down to 11.97%. Meanwhile, Fubo TV's revenue growth fell from an explosive 1,000% down to just 43.48% in its most recent quarter. Next, I wanted to look at operating profit margin for the trailing 12 months. And Roku, starting with the top, you can see its operating margin was expanding during the time in the earlier stages of the pandemic when its revenue was also exploding. Now that economies have reopened and that's gained momentum, we're spending less time at home watching TV. Roku's operating margin is falling. Meanwhile, Fubo TV, as they were experiencing explosive revenue growth, their operating margins were improving. However, that growth has flatlined, and since January of 2022, their operating margin has been roughly flat at negative 50%. So they're losing a lot of money here, Fubo TV is. The next metric I wanted to look at is cash flow from operations. And again, similar story here for Roku. They benefited in the earlier stages of the pandemic and their cash flow from operations exploded over 200 million in the trailing 12 month at its peak. Now it's down to negative 20.98 million at the most recent update. Meanwhile, Fubo TV has just been heading in the wrong direction and fast, losing 344 million in cash flow from operations in its trailing 12 months. The next metric I wanted to look at is diluted shares outstanding, and this metric is important because it highlights how many shares outstanding the company has. That means when eventually they do become profitable, or if they become profitable, this is how many shares those profits are going to be split among. Right? So you take your profits and it's going to be split among all of these shares. And so with the more shares outstanding, that means per share, it's going to get less profit. So the earnings per share will be smaller with the same amount of profits if there's more shares outstanding. So that's why it's important that companies don't dilute their shareholders too much. And I pay attention to this metric, especially for growth companies. And here you have Roku's shares outstanding increasing from 100 million to 138 million, so roughly 38% increase in its share count over the last 3 to 4 years, which is a lot, but it's not, it's peanuts compared to Fubo TV's share growth from less than 5 million here to all the way up to 186.75 million. Explosive shareholder dilution from Fubo TV to go along with all of its massive losses in terms of cash flow from operations and operating income. So finally, I wanted to look at valuation, and I chose to use the price to sales forward ratio because these companies are not consistently profitable and they're losing a lot of cash flow. And so to put them on consistent equal footing, I chose to use the price to sales. And in this metric, Roku TV at 2.1 is considerably more expensive than Fubo TV at 0.269. However, I believe that Roku has earned this premium valuation over Fubo TV. Fubo TV is just losing too much money on the bottom line. Operating margins are not improving. It's diluting shareholders substantially. And so if I had to pick one of these two stocks to buy right now, I would say Roku stock is the better choice above Fubo TV stock. Okay? That's all I've got for this video. As always, I appreciate you tuning in for these videos, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.